Hello and welcome. In this video, I'll share two powerful techniques that can significantly improve your trading. I'll be using the Deriv platform for this tutorial. You can access it through the link in the description below. The two strategies that I'll share will help you spot potential retracements, avoid false signals, and make more informed trading decisions. I'll start by explaining each of the strategies, then illustrate an example. The first strategy is always using top-down analysis. Top-down analysis is a method where you start by analyzing the larger time frames before moving down to the smaller time frames. As a day trader, I'll begin with the one-day chart to identify the dominant trend, whether it's bullish or bearish. After knowing the dominant trend, I'll move down to analyze the 8-hour chart, then the 4-hour chart, the 2-hour chart, and so on until I reach the 1-minute chart where trades are executed. The second strategy is using the stochastic oscillator, which you'll use to ensure that you're aware of every retracement. The stochastic oscillator is a momentum indicator that helps identify overbought and oversold conditions. After every overbought or oversold condition, we often see a retracement, also known as a pullback. The stochastic oscillator helps us anticipate these moves. Since we're using top-down analysis, we'll check for overbought or oversold conditions on each time frame, starting with the one-day chart and then going down to smaller time frames. This ensures we are aware of potential retracements as they develop. This is important because retracements affect the dominant trend. Even in a strong uptrend, you'll see some bearish candlesticks, and in a downtrend, you'll see bullish candlesticks. These movements happen because lower time frames experience retracements before the market continues in the dominant trend direction. If we only focused on the dominant trend without considering retracements, we might get caught off guard by these pullbacks. Let's look at this previous bearish dominant trend on the one-day chart. Even though it was generally bearish, you can see bullish candlesticks. These bullish candlesticks indicate that another time frame reached its oversold and retraced, then continued with the bearish dominant trend. To solidify your understanding, I'll walk you through an example on the Volatility 10 index, but these techniques can be applied to different markets. Open the one-day chart and start by locating key support and resistance levels. Use horizontal lines to mark these levels. In the sidebar, click on Drawing Tools, All Drawings, then select Horizontal Line. Place one horizontal line at the support level and another at the resistance level. The main reason for doing this is to ensure that we watch for possible reversals or breakouts when prices reach these points. After that, confirm the dominant trend. Just to see clearly, I'll add a moving average and a simple moving average. But keep in mind that I'm not using these indicators to generate any signal. Click on Indicators in the sidebar, then click Moving Averages and select Moving Average, which will appear as a red line. I'll also add a simple moving average, which is provided by the Bollinger Bands. Click on Indicators in the sidebar, then click Volatility and select Bollinger Bands, which will appear as 3 white lines, but we'll focus on the middle white line, which is the simple moving average. If the daily candlesticks are above both the moving average and the simple moving average, then the dominant trend is bullish. But if the daily candlesticks are below both the moving average and the simple moving average, then the dominant trend is bearish. For a clear bullish dominant trend, the simple moving average should be above the moving average and the daily candlestick should be making higher highs. I'll show an example. This is a previous bullish dominant trend on the one-day chart. We can see that the daily candlesticks were making higher highs and they were above both the simple moving average and the moving average. For a clear bearish dominant trend, the simple moving average should be below the moving average and the daily candlestick should be making lower lows. This is an example of a previous bearish dominant trend. The daily candlesticks were making lower lows and they were below both the simple moving average and the moving average. As a day trader, I use the one-day chart to check for the dominant trend, However, as we've seen, even if there's a clear bullish or bearish dominant trend, there'll always be retracements, and that is the main reason why we need the stochastic oscillator to ensure that you're aware of potential retracements. And since we're using top-down analysis, I'll introduce the stochastic oscillator in the 1-day chart and move down to lower time frames. Click on indicators in the sidebar, then click on momentum and select stochastic oscillator, which will appear at the bottom of the chart. I'll then check for overbought or oversold conditions, starting from the 1-day chart, then the 8-hour chart, the 4-hour chart, the 2-hour chart, and so on. Keep in mind that I start by checking the dominant trend on the 1-day chart, then use the stochastic oscillator to identify any overbought or oversold conditions, starting from the 1-day chart and moving down to lower time frames in a descending manner. When a larger time frame chart is retracing, the smaller time frame charts will move in the direction of the retracement. Therefore, you'll have to check for a candlestick signal in that big time frame chart that's retracing to determine the start or end of that retracement. I'll show an example, and I'll use this previous bearish dominant trend in all the examples. When the dominant trend was bearish, this 4-hour chart reached oversold and retraced, then continued with the bearish dominant trend. At this point when it was oversold, we see a bullish pin bar indicating the start of a retracement. It retraced, and this doji at the moving average indicated the end of the retracement. Then the bearish dominant trend continued. Later, it was oversold again. This bullish pin bar was an indication of the start of a retracement. It retraced. This doji was an indication of the end of the retracement, and the prices maintained below the moving average because the dominant trend was bearish. I have done another video that explains more about the retracements, and I've linked it at the end of this video. Whenever there's an overbought condition, the buy is stronger than the sell. And whenever there's an oversold condition, the sell is stronger than the buy. Therefore, always wait for a candlestick signal to confirm the start of a retracement. For example, during the bearish dominant trend, this 2-hour chart was oversold and it did not retrace immediately. The oversold prolonged for some time, and during the oversold, the sell was stronger than the buy, until when this bullish engulfing bar was formed, and this bullish pin bar indicated the start of the retracement. When an oversold or overbought condition prolongs, it easily extends to the next bigger time frame. Even on this day, when the oversold condition in the 2-hour chart prolonged, it extended to the oversold condition of the 4-hour chart. It's also important to keep in mind the stop-loss hunting strategy, whereby liquidity is added before the market proceeds in the predicted direction. Mostly this happens in the smaller time frame charts, and this is another reason for using top-down analysis, so you should always trade according to the bigger time frame charts. It's crucial to wait for a candlestick signal to confirm the start or end of a retracement. Look for patterns like engulfing patterns, doji, or pin bar. You can choose whether to trade the retracements or just wait for the dominant trend, which is more predictable, but always check for overbought or oversold in other time frame charts before placing a trade. I'll do another video illustrating how to trade the dominant trend, so hit the notification bell so that you can be notified as soon as I post it. To summarize, before executing a trade, check for the dominant trend on the 1-day chart. Use the stochastic oscillator to check for overbought or oversold conditions in the different time frames, and use top-down analysis when analyzing the charts. By combining top-down analysis with the stochastic oscillator, you ensure that you trade with the trend and spot retracements before they happen. This strategy will help you make more confident trading decisions. Always manage your risk and practice on a demo account before trading with real money. If you found this tutorial helpful, don't forget to like and subscribe. Thank you.